Hello, everyone. Thank you for joining the DealMaker Series, where I am interviewing top deal makers in the DFW area. My name is James Sackey. Today, I am joined by Mr. Alex Vantarakis of the Vant Group. Alex, give us a little bit of introduction about what you do in your company.
Absolutely. It's a little cold today. Today's the coldest day in Dallas, so got to get bundled up today. But yeah, my name's Alex Vantarakis with the Vant Group. We are in our 26th year of being a local M&A firm. What does that mean in plain English? We help people buy, sell, and value companies.
Excellent, excellent. Just real quick, I'm curious just for myself. How long have you been operating your firm?
I bought a business in 1998. I bought it and I sold it, and I loved the process of buying and selling it. I did not enjoy owning it. So the next year in 1999, I just decided to start my own firm. So this will be our 26th, we're going into our 26th year.
26. Wow, that's awesome. That's very impressive. I love it. And is there any particular client profile that you serve, that you look to serve, or any particular verticals or anything like that?
Great question. Our discerning attribute is EBITDA or cash flow. We really like EBITDA to be a minimum of about $500,000. Our deal sizes, it range anywhere from $1.5 million to about $100 million. We're actually going to pitch a $130 million deal in California next week, so that high end might be longer. It might be higher next year. But we pretty much are a boutique M&A firm that takes kind of investment banking from Wall Street and brings it down to Main Street. 80% of the businesses are under $100 million in value. So those are the ones that we've decided to work on, but with the same professionalism that they would get if they were a billion-dollar business, on Wall Street.
Excellent. Love it. All right, well, let's get right to it. Let's get to some of these insights. So how would you describe the current state of transactions and deal flow here in DFW or Texas as a whole?
Absolutely. We live in one of the top 3 entrepreneur capitals of the country, probably of the world. It's kind of Dallas, Fort Worth, believe it or not, like the Florida area, not as much California, but like Atlanta, a lot of the East Coast states. And frankly, 26 years of doing this, there's always M&A activity. Always, always. And the reason is, if you're in a great economy, well, you have a lot of money, you have surplus, you want to grow, you're a HVA business in Dallas and you want to grow to Fort Worth and other areas, you're going to go out and acquire other businesses. If times are going well and you're a individual working in a corporation, you want to buy a business, when times are good, you can take a chance, right? If it doesn't work out, you can go back to corporate America. Flip it around, if the economy is down and you're a company that is looking to grow and your sales are down, and you can't get any more existing sales from your own business, you're going to go look external to buy a business. And if the economy is down, you have a lot of people that have been laid off that have decided to take their 401k or their retirement plan and go and buy a business. So we're very fortunate. Does it tick up and down during particular times? Absolutely. Right before the election any election for president is a very slow time. You don't know who's coming into office. You don't know what's going to happen with capital gains, et cetera. And then obviously interest rates play a huge factor in our business. The same reason why when interest rates go up in the residential market, prices come down, activity slows down because the cost of capital is more expensive. It's the same in the smaller arena. But having said that, I worked in 2006 when interest rates, actually 2006 and 2023 and 24. And now, interest rates are 12 to 13% to buy a business. It's a little lower today as we speak. I also worked when interest rates were 6%. So, that 6% spread is pretty substantial, right? You buy a $3 million business, for example, 6% a year on interest, that's 180 grand of interest. So what happens in that case? Either the buyer is going to pay the price that the seller wants and figure it out, or the seller is going to have to take a haircut. But let me tell you, sellers are not very keen to not getting maximum value, regardless of the situations that exist in the markets.
Yeah, I've been getting a lot of that. The difficulty here lately, like the last year or so, has been around the mismatch of what's being offered versus what can actually close. So I can attest to that myself. But so I'm curious, just kind of to follow up a little bit on that. I think you were alluding to it momentarily. Where are you finding value, or where maybe are buyers finding value, would you say?
In the businesses they're looking to acquire?
Yeah.
Yeah. Everything flows from EBITDA, not revenue. Revenue is a great number, right? But if you got 10 million in revenue and a dollar in EBITDA,
Yeah.
you've got a worthless company. So everything stems from EBITDA. And in the small business community, when we say EBITDA, we really mean a term called adjusted EBITDA, because in these small businesses, there potentially could be non-business expenses that are run through the business. And you basically go in and do a recast to determine what the real EBITDA would be. And then everything is a multiple of that. The good news is there's buyers for every level of EBITDA, because every level of EBITDA is a different price. So if you've got, I'll give you an example. This company we're doing in California has 13 million in EBITDA, and we're valued at 135 million. So that's a little over a 10 times multiple. Let's go to the other end of the sphere. We've got a company that it's a landscape design business. So they design the landscape. They do not install or clean. They just design. They have about $500,000 in EBITDA, and that business is only going to sell for maybe $1.65 million, so about a 3.2 multiple. So the buyers are looking at EBITDA first. After that, depending on the buyer, is dependent on what's important to them. There's probably 50 factors that affect their value decisions, and I won't go over all of them, but I'll highlight. Does it have a good management team? Is the owner intimately involved in the business, or is he an absentee owner? Is the business declining? Is it flat, or is it growing? Are their accounts receivable 30 days or less, or 180 days or more? So there's a lot of factors beyond the revenue and the EBITDA that can really affect it. And that's what's really so fun about our business. It's like putting a bunch of puzzle pieces together.
Yep. Yeah, for sure. So you kind of touched on this earlier, and it kind of segues into this next question, and that's around how the current climate is with interest rates, and now tariffs have been introduced. How is that impacting deals, or how is that creeping into conversations?
Yeah. Well, the good news is interest rates are coming down. They were at a high probably, I don't know, maybe 9-10 months ago before they started clicking down the Fed rate. Everything is tied off of prime. Yep. Everything is tied off of prime. And, as interest rates go down, deals become more affordable. So more transactions are usually consummated. Having said that, if you have a good quality business that has good earnings priced at a reasonable multiple, buyers are never the issue. For every good business, there's 50 buyers chasing that one business. So ultimately, somebody's going to pay the price that the seller wants. But interest rates going down obviously greatly affects and increases the trend.
Yep,
tariffs, that one's interesting because they haven't been implemented yet. Right. A lot of people are scared. Buying from China is great until it's not, right? Yep. During COVID, I can't tell you how many clients I had that bought a business before COVID that were getting their products from China that are out of business right now. So, and what was going on during COVID, for those of you that don't know, freight charges were astronomical. So the price of the product didn't increase, but the freight quadrupled and was a 5-10-fold. Instead of paying $2,000-$3,000 for a container, you're paying $20,000-$30,000. I would assume it would have a similar impact, but I don't believe that Trump is going to. I think Trump is doing excellent negotiating with all of these tariffs. Look what happened with Mexico and Canada. Is there a tariff on Mexico and Canada today? No, because they did what was in the best interest of the country. I'm sure something similar will happen with China and the other countries. As a matter of fact, he's looking for a reciprocal tariff.
Right.
Meaning anybody that's tariffing us, we are going to start to. I don't believe any of that will go through. But let's say it does. Obviously, that's not good news. That'll make everything more expensive in the short term for everybody. It is only a big deal if you can't pass the cost, right? If I own a company and I buy something for $10 and I sell it for $20, and now it's $11, but I sell it for $22, I haven't lost anything. So I don't think the owner will suffer as much, although certain businesses, there's not a lot of price elasticity. But if everybody's raising their prices, all that means is the product will be more expensive. Sales will be artificially increased. but I don't think it'll affect value that much. At least I'm an optimist, right? I
Yeah.
don't want to believe that it will.
Yeah, I'm with you on that one as well. And so I think that could probably segue pretty well into my next question, and that's what trends in strategy or deal structure are you seeing now?
A sale price is one component of the deal, and everybody gets fixated on the sale price, and they forget things like, how are you going to pay for the business? And I always use this example when I do presentations. I got a great business. You love it. Would you rather pay 10 million or 20 million? Well, of course I'd rather pay $10 million, right?
Yeah, of course.
Well, it's $10 million, $1 a day for 20 million days. Price and terms are extremely important. The most secure type of payment is cash in hand, check at closing. As you move down the stack, the next one down is owner financing.
Yeah.
So think of you being a second lender, like when you go buy a house, instead of getting PMI insurance, you go and you get a small second mortgage. Well, that second mortgage is a lot more expensive, and frankly, it's a lot riskier, right? Because the first mortgage has the property as collateral. So as an owner, sure, I might get a good interest rate, but if the buyer doesn't want to pay me, but is paying the bank in front of me, and I've seen this, good luck trying to chase the person. Owner notes, and then under that are earnouts or contingency payments. When would you need a contingency payment? I'll give you an excellent example. We have a business we're selling that has $6 million in EBITDA. It's an amazing business. Amazing business. The multiple is extremely low, and there's a huge earnout component. They have one customer. So if you have one customer that's 100% or one customer that's 50%, going back to your deal structure, you're most likely going to get half of the money up front and then half on a contingency payment down the road.
Yeah.
So that's the third option. And then you got a whole bunch of other creative options. You can take stock in somebody else's company. You can take crypto. You can take a piece of land. You can do a lot of things. But how have deal structures been affected in the last couple of years? With interest rates so high, banks have a maximum on what they can lend based on debt coverage ratios. Well, when there's a gap and the bank isn't going to fill it, you really only have two options. Either the buyer's going to come up with more money down, or the seller's going to participate in the deal. So we've seen a little bit more participation in deals than we normally see.
Interesting shift in the trend there. Okay, so all right, last question, or maybe last question, we'll see. What makes DFW unique, or Texas, like the Texas market, unique versus all the others?
No state income tax.
Yeah, I've heard that.
Period. Cheap cost of living, friendly environment, entrepreneurial spirit, massive area of land, great people, great labor force, no unions. So all of the things that you hear people belly aching about on the West Coast and the East Coast, and all the junk that you hear of how those states are ruining themselves, as of today, none of that really exists in Texas. It is a great convergence of all of these factors that make people want to come in. Also very centrally located, right? If you're a manufacturing company and you're in Texas, you're halfway between the country, you're halfway up north, you're close to Mexico. This is a great geographic. The only thing better would have been if we were on the water and were able to get some stuff down in Houston. But Dallas is such, because we work around the country. Like, I'll give you a great example. California. You try to do business in California, and I swear it feels like they do everything in their power to not do deals. So I'm trying to do a deal in California as an outside M&A firm, and I have to jump through so many hoops just to have the privilege of being hired by a company in California. Well, then after that, they got all these regulations and taxes that they want to start taking and scraping off of ours. And honestly, sometimes now for a $130 million deal, it's worth it. But a deal smaller than that, you kind of have to second guess it, And then other things like population count. We were going to get a business in Wyoming, great business. Well, then I looked at the population in Wyoming, and it was less than the two cities that I live in.
Yeah.
So There's so many factors that affect the deal. You can't even imagine the location. If you have a business in Dallas, Fort Worth versus 60 miles in the country, even though expenses and ease of being in the country might provide you even a higher EBITDA, well, you have to go to the country to live to run that business.
Yeah.
So even just as something as simple as geographic location makes it difficult, makes a business more or less expensive and more or less marketable.
Yeah. Yeah, no, for sure. Some of those things I've been hearing in some of my other interviews. Some of them I have not. That's good. I like that. I hadn't heard of the lack of unions being here as one of the benefits. But yeah, you're 100% correct. Yeah, it's much friendlier business environment for sure. Alex, I appreciate your insights. Those are excellent insights. Honestly, I appreciate you taking some time to share with me and my audience. For those of you watching, hopefully this was useful for you. You can find more interviews like this and more information on my website at jamessackey.marketing. Thank you so much for tuning in. Alex, thank you for sharing with us.
Absolutely. God bless you and everybody listening.
Thank you. Thank you.